Okay, let's unpack this. If you're managing money, investments, or, paychecks anywhere near the world's longest border, you've probably had that stressful thought. If I'm earning in both CAD and USD, or moving between countries, how much am I really going to owe?
Welcome to the Canada versus U.S. tax showdown. Our mission here is to give you that shortcut, the deep dive into understanding these two uh, colossal tax systems side by side. As one of our sources put it, trying to compare them is, well, about as different as poutine and Philly cheesesteak.
I love that. You can't just swap the ingredients.
Not at all.
And it's funny because both countries have built their systems on this idea of being progressive. The more you earn, the higher percentage you pay. But the fundamental rule book, specifically how each country decides who they can tax, that's where everything diverges.
That is the critical starting point. Let's look at the philosophy. The United States uses what's called citizenship-based taxation.
Okay.
And simply put, Uncle Sam claims the right to tax you whether you are earning a living in Alabama or Abu Dhabi. If you hold that U.S. passport, you file every single year, period.
And when we say the U.S. tax bill, we're not talking about just one number. It's a whole stack of things.
It's a stack. You've got your federal income tax, then payroll taxes.
Right. That's FICA, Social Security and Medicare.
Exactly, FICA. And then you have the wild card, state income tax. That's how you get California with rates, flirting with 13%, but then Florida with 0%. It's a total patchwork.
And we should probably emphasize this isn't just for citizens.
Oh, absolutely not. If you are a green card holder, you are generally taxed as a resident alien until that card is formally, legally relinquished. You could live abroad for a decade, never set foot in the U.S., and the IRS still considers you a resident for tax purposes. That liability doesn't just switch off.
That long reach is always a surprise to people. So north of the border, Canada operates on a completely different core idea. Residency-based taxation. The Canada Revenue Agency, the CRA, they care about where you hang your hat, where your family is, where your economic life is centered.
Right.
For Canadians, the tax bill combines federal income tax with a layer of provincial tax. And that provincial tax can drastically swing your rate. And payroll contributions are the Canada Pension Plan, CPP, and Employment Insurance, EI.
So how do they define residency? It's not always just a simple address.
It isn't. It's often a facts and circumstance test. They look at your ties, your home, your dependents, your social connections.
But there is a hard rule, isn't there?
There is. The sojourning rule. If you spend 183 days or more in Canada during a calendar year, you're automatically deemed a resident for that entire year. No questions asked.
So these two systems define who we're talking to today, the cross-border taxpayer.
Exactly. Non-residents, dual filers, expats, anyone who has to navigate both the IRS and the CRA at the same time.
Okay, let's drill down on the numbers. Let's find out what the actual damage is. How do the federal rates for 2025 stack up? The U.S. federal rates range from 10% up to a top rate of 37%.
37, okay.
But, and this is crucial, that top bracket only applies to income over $626,000 for a single filer. It hits the very highest earners.
Okay, and in Canada?
In Canada, the federal rates go from an effective low of about 14.5% for middle earners up to a top federal rate of 33%.
So the top U.S. federal rate is actually higher.
It is by 4 points. But here is where it gets really interesting. The combined bite.
The state and provincial taxes.
Yes. Once you stack those on top, the U.S. often looks competitive. Combined U.S. rates usually range from 37 up to around 50% in the most aggressive states. But Canada's combined rates, they often start around 40% and can go up to an eye-watering 53%.
53.
Ontario's top marginal rate is currently hitting 53.53%.
Wait, so when we're looking at marginal rates, the tax on your next dollar an expat in Ontario could be paying a higher percentage than a high earner in, say, California.
Absolutely. Canada is aggressive at the top end of the income scale.
Let's make this real. Say you earn $100,000 US.
Okay. In California, you're stacking federal, state, and FICA. You land at an effective rate of roughly 28 to 33%.
And in Canada, let's say British Columbia.
A comparable income in BC, about 137,000 Canadian dollars, your effective rate is about 28 to 32% after credits.
So at that middle and upper middle income level, it's surprisingly similar.
It's very similar. The systems are designed to get a comparable amount from the average professional. The key insight is that the U.S. has the higher maximum federal rate, But Canada's provincial structures can lead to a steeper overall total marginal rate for top earners.
Which brings us to the biggest headache for a U.S. citizen living in Canada,
Yeah.
double taxation.
Right. You're taxed by Canada on residency and by the U.S. on citizenship.
How on earth do you solve that?
You solve it with the U.S.-Canada Tax Treaty and specialized tools within it. They're designed to eliminate that double burden, so you basically just pay the higher of the two rates.
Okay, so what's the first line of defense?
The first one people usually hear about is the Foreign Earned Income Exclusion, or FEIE.
Right.
It lets U.S. citizens abroad exclude a pretty significant chunk of their Canadian employment income from U.S. tax. For 2025, it's up to $130,000.
But you have to qualify.
Oh, yeah. There are strict tests, like the physical presence test. You have to be out of the U.S. for 330 full days.
And the other option?
The other, and often more powerful tool, is the foreign tax credit, the FTC. This gives you a dollar-for-dollar credit for Canadian taxes you've already paid against your U.S. tax bill.
Okay, so walk me through that. If I owed the CRA $30,000 and the IRS says I owe them $25,000 on that same income,
that $30,000 you paid to Canada acts like a coupon. It completely wipes out your entire $25,000 U.S. bill.
and you'd still have $5,000 in credits left over.
Precisely. And that's why, since Canadian tax rates are generally higher, most U.S. expats in Canada use the FTC. It almost always zeroes out their U.S. tax.
But, and this is the big, but even if you owe $0 to the IRS, you must file a U.S. return every year to claim these benefits.
If you don't file, you don't get the relief.
Yeah.
You're just non-compliant.
Okay, let's move beyond income tax. What about social program contributions?
In the U.S., it's FICA. The employee pays 7.65%. If you're self-employed, it's 15.3%.
And in Canada?
In Canada, you have CPP and EI. But unlike FICA, these contributions are capped.
Meaning?
Well, the employee share of CPP is around 5.95%, but only up to a certain income threshold. Once you hit that max for the year, you stop paying into it.
Okay, what about sales tax? That's something you feel every day.
It is, and Canada generally has a higher burden here.
Yeah.
The U.S. has no national sales tax. It's all state and local.
Right. 0 in Oregon, but up to 10% in places like California.
Canada layers the federal GST, that's 5%, with provincial taxes. And in many places, they combine into the HST, which can hit 15%.
15%?
In provinces like Labrador and Newfoundland, yes. It's consistently higher.
Now let's talk investing. This is where a simple mistake can get really expensive.
Very expensive. We need to look at capital gains and, critically, business structures.
For capital gains, the U.S. is famous for its favorable long-term rates and the primary home exclusion.
Right, you can shield up to $500,000 in profit if you're married. Canada's system is different. For residents, only 50% of your capital gain is taxable.
Which is pretty competitive.
Very. But if a non-resident sells Canadian property, they still only include 50% of the gain, but they generally lose that valuable principal residence exemption.
And that can be a huge tax bill.
A huge bill. And it triggers immediate withholding requirements.
Now, what's this critical warning you mentioned for investors?
It's the U.S. LLC, the limited liability company. It's often recommended by U.S. advisors as a flow-through entity.
So profits just flow to your personal return.
For the IRS, yes. But for a Canadian resident, the CRA does not see it that way.
Uh-oh.
The CRA views the U.S. LLC as a corporation. This is a massive problem. It means the LLC gets taxed twice, once at high Canadian corporate rates, and then again when the money's distributed to you.
So classic double taxation.
Severe double taxation. It's a structure you should almost always avoid if you're a Canadian resident.
Okay, before we close the books, we have to cover the final paperwork, the reporting forms with those massive penalties.
Even if you owe zero tax, both countries want disclosures. For Americans, it's the FBAR.
Report of foreign bank and financial accounts.
Correct. Mandatory if you have $10,000 or more aggregated across all your non-U.S. accounts. That includes your Canadian checking account.
And for Canadian residents.
If you hold specified foreign property, so foreign investments, with a cost over 100,000 Canadian dollars, you must file Form T1135.
And if you forget,
the penalties are staggering for both forms. They often start at $10,000 and escalate fast. It makes these forms arguably more important than the tax return itself.
what about when you leave for good? The exit taxes.
Canada has a departure tax. The moment you become a non-resident, Canada deems you to have sold most of your worldwide assets at fair market value.
So they tax you on growth you haven't even realized yet.
Exactly. You have to pay or secure that tax before you go.
And the U.S.?
The U.S. has the even more severe expatriation tax. This applies when a U.S. citizen renounces citizenship or a long-term green card holder gives it up.
If they're wealthy.
Right. If they meet certain high wealth tests, like a net worth of $2 million or more, the tax is calculated by pretending all your worldwide assets were sold for cash on the day you leave.
Wow. Okay, final filing tip.
Get help. Cross-border taxes are a specialty. Only use preparers who hold a U.S. PTIN, a Preparer Tax Identification Number. They're the only ones who can legally charge a fee to prepare a U.S. return.
Don't just use your regular accountant.
Please don't. You need a cross-border specialist.
So after all that, what's the verdict? Who pays more?
It's the question everyone asks. And the answer is, it's complicated.
Of course it is. But as we've seen, Canada typically has the higher income tax rates, especially those marginal rates hitting 53%.
It does. But that money funds universal health care, robust parental leave, and other social benefits. It keeps your out-of-pocket costs much lower.
No $2,000 ambulance rides.
No crippling private insurance premiums. You're not as worried about the cost of long-term care.
Conversely, the U.S. might offer lower federal income tax rates. But that savings can get eaten up pretty fast by private health insurance, property taxes, and the crushing cost of higher education.
The true comparison isn't the tax rate you see on a chart. It's the net outcome, your peace of mind. Sometimes a country with a higher initial tax rate actually leaves you with more money in your pocket at the end of the year.
We mentioned earlier that U.S. green card holders remain taxed as residents even if they live abroad indefinitely. We also learned the U.S. tax treaty has a special tiebreaker rule that can let a green card holder in Canada claim non-resident status for tax purposes, a great way to avoid U.S. tax. But, and here's the catch, claiming that treaty benefit can automatically subject you to that severe U.S. expatriation tax regime we just discussed. So given how serious that expatriation tax is, what critical step must you take before claiming that treaty benefit to protect your finances from those potentially multi-million-dollar penalties?